You know what ridiculously annoys me about stuff like that? What this guy's going on, I had to close it off actually. I couldn't listen to him. Is the CEO of Charles Schwab Asset Management. He's going on about, yes, well, over the long term, and most of the time stocks go up. That's all very well, but if you don't understand the psychology of most people, which is they think they can hold for the long term, they think they can take the pain of 80%, 90% drops, which never then recoup, then you'll find that his comments are, in his nice suit and tie and all the rest of it, are just completely disjointed from reality. The fact of the matter is, there is a time when people should get out. They might have an exit if something drops 25% from the highest it's been since they've bought it. The problem with people like this is they're flogging funds which basically can't move nimbly. They can't say, oh, we've got $1 trillion under management, which we have got because we market the hell out of our funds and people will go in name recognition. And we can't put a sell order on, $5 billion worth of Microsoft stock. So they've got to keep talking up the book. And I guess ARK and Cathie Wood are a good example of that at one extreme, which is just keep talking up the book, because the thing they can't say is, hey, it looks like it's going to continue falling for a while, at least the next 1, 2, 3, 4 months, and we think we might want to go into cash. They can't do that. Private investors can. Private investors, unlike the Titanic of a fund manager heading for an iceberg they can see ahead, the private investors can paddle away in their lifeboats and save themselves. And that's one advantage to being a private investor. Of course, it still raises the question, well, when do you get in? Getting in is a separate issue when you have to look at valuations, revenue growth, and everything else. What I'd say is what private investors should perhaps focus on is screeners. Look at the screens. Just screen the hell out of a stock, just like you do most things in life. Whether it's on Tinder, you screen, you should. Whether it's on Grindr, you should screen. Whether it's on Match.com or in anything else, in any other decisions you make, you screen the hell out of it, okay? Until you get a small enough number from a large enough pool that you've removed all the things you don't want. If you pick a small gene pool, you're going to have to take what the hell's out there. That's why inbreeding's a bad idea, and that's why looking at a small group of equities, like, oh, well, we're just going to pick from a particular geographic region or a particular set of styles, is a bad idea. Okay, so bottom line, long-only fund managers talking up their book because in actual fact their hands are tied behind their backs, going back to Tinder, I guess, is not good, not sensible, and it's actually just complete BS, the inherent bias within it. Do I have a bias? Yeah, it's a bias towards private investors learning to do it for themselves, so that they can not ride the roller coaster of death all the way down. In a way, I guess it's like saying to the people getting onto the Titanic, yeah, fine, go ahead, learn to swim and stand close to the lifeboats, so you've got plan B. That's it.